All right. Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And as you can tell, I'm super excited today because we have a very special guest on the program. He is the patron saint of uranium investors around the world. It is, of course, the great man, Scotty from Sownreap Capital, aka When Moon. So I've got some questions for Scott today. Thank you for all of you who gave me some input into the questions that you'd like me to ask. Quick disclaimer, guys, anything that Scott or I discuss on this channel or anywhere else is just our opinions, is what we think and what we're doing potentially with our money. None of it constitutes or is intended to be financial advice. This is just what we're doing. You need to really understand that and make sure that you are responsible for any actions which you take, and we cannot guarantee any of the information that we put forth today. It's just for entertainment purposes only. So please do make sure you seek the services of professional financial advisors, which we are not. Having said that, Scott, how are you, my friend?
I'm doing fantastic, thank you. How are you, Ben?
I'm very well, all the better for seeing you. And today, mate, I thought I'd just literally read a tweet that I saw on Twitter from Robert Kiyosaki, and it goes like so. Time for poor to get rich. Stocks, bonds, mutual funds, ETF and real estate crashing. As predicted, middle class being wiped out. Silver moving sideways. Silver to stay at $20 for 3 to 5 years and then climb to $100 to $500. Everyone can afford silver now, even the poor. Accumulate silver. Now, I know you're a huge silver bull. I'd like to start with you briefly giving an intro into Sownreap and then talk to us a little bit about where you think we are in the macroeconomic cycle.
Yeah, sure. Sownreap Capital. I mean, it's a channel that I started with Steve, my mate Steve, and we primarily focus on uranium because obviously I'm most bullish uranium. I do like silver, but I like uranium even more. So we cover quite a lot over uranium, and also because we're a Jesus believer, we do talk quite a bit about Jesus, and hopefully you'll get to hear the good news of the Bible and get to know Jesus.
Absolutely, absolutely, because that is prosperity. Okay, poverty is a sin, and prosperity is what we're all aiming for towards a higher quality of life. Sometimes we get caught up in the technicalities of things, and it's important to take a step back and think, well, why are we doing this? Why are we so interested in it? And of course, it's to increase the quality of our lives and that of our family and our communities. So very important for us to keep that in mind as we move forwards. In terms of the sector that you believe the most in, we all knew what your answer was going to be there, and you beat me to it. Where do you think we are in this very interesting macro cycle? We've seen the Dow, the S&P, and the NASDAQ down nearly 5%, so 4% of 5% on the day. A lot of talk about inflation out there. Where do you think we are, and how does that fit into your thesis of a commodities super cycle coming forth in the next decade?
Yeah, sure. I'll just share my screen with you here.
Absolutely.
So what I've got here is the Fed funds rate right at the top, and then the inflation rate here in the second part in the blue line. And then you've got the oil to Dow Jones ratio, which talks about basically, I'm a big ratio believer, basically. So I see that there are periods where commodities outperform the general equities in the bond market. There are periods where general equities outperform everything else. There are periods where bonds outperform everything else. So they are the three major asset classes, if you want to call them that. And obviously there's real estate as well. But what I do focus my effort primarily on is looking at the ratio and looking at where the money's rotating. So you see here, US oil divided by Dow Jones. So it's oil's performance relative to general equities. And what you see here is an outperformance in the 1970s, for example, a massive outperformance of oil compared to general equities. And what we're seeing right now is potentially the trend changing and the money flow starting to happen from general equities into oil, into commodities. And the conditions for that, if you want to look at the macro picture, I think we've got the perfect setup for the commodities bull run. And the reason why I say that is, as you see in the inflation rate, so this is rate of inflation by Fred. And so you see the inflation rate really pick up during the early or late 1960s to early 1970s. And what you've seen is a vast outperformance of commodities. And the reason for that is this. So basically what happens, this is a misconception, I think, when people think Fed just determines the rate, the Fed funds rate, the cash-free, the risk-free rate. And that is really not the case. So what happens traditionally is the bond market chases the rate of inflation. So if you really think about it, if the inflation is sitting at 5% and the bond yield is sitting at 2%, well, the bondholder is going to simply go, no, I'm not holding this bond anymore. I'm going to chuck it away. This is yielding me negative yield.
There's a huge negative carry there.
That's right. So bond yield will have to rise at least until it matches the rate of inflation, or it goes above it so that it is yielding a net neutral return or a positive return. So right now we're yielding massive negative return because US inflation rate is sitting at 8.5% and Fed funds rate is sitting at 2.33%. And I think there will come a time when this catches up massively to the rate of inflation. And so what happened during the 1970s is really important. So you see the inflation starting to pick up. The Fed funds rate catches up, right? On three occasions. So back here, 1969, here, 1974, and then also at the peak here, which was around 1980. During that time, look at what happened to the performance of oil relative to general equities. What this is really telling us is the bond market is one of the largest markets out there. It means there's a lot of money stored within the bond market. When that money flows out of the bond market, which is shown by, obviously, if you look at the Fed funds rate, there's a direct inverse correlation between the price of the bond and the yield that the bonds yield. So the money is flowing out as the bond rates are going up, or the Fed funds rates are going up. So that money has to find a place to go. And the kicker to that is we've got a massive high inflation, which means if you were to sell your bonds and store in cash, it's just going to be losing purchasing power. So where does that money go? Does it go into equities? Or I don't think so, because during the 1970s, we've seen a flat performance equities, very, very poor performance equities compared to commodities. And the reason for that is when the bond yields are rising and when the interest rates are rising, your valuations of general equities, cash flow businesses, based on your traditional valuation metrics like NPV calculations, so net present value calculations, or discounted cash flow calculations, go down dramatically. So now you've got a condition right now, which is really similar to the 1970s, just on steroids, because now it's a global phenomenon. Everyone's cashed up. If you look at the GDP, if you look at the cash savings of everyday person in the United States, for example, we're sitting at something like $85 billion across the entire population in the United States back in 2007 and 2008. Now we have $4.4 trillion. We've got 50 times more cash that is just residing in people's bank accounts.
And why is that? Is that a result of the monetary and fiscal policies over the last 2 years to do with the pandemic?
Yes, it is. It is 100% that. And the savings rate also shot up during the pandemics as well, because people were just home, not spending money. They were getting all the free money from the government, helicopter money. So not the savings rate, but the cash that they've got now stored I can just show you that actually. So if you just go Fred, check the deposits.
Consumers have they're sitting on a large amount of dry powder that will potentially enter into the markets.
That's exactly right. On top of that, what I'm trying to say is, so you've got 2007, you've got these really low rates of cash savings. And right now we're up here. And this is how much cash the individuals have compared to 2007. And this is why we went into a deflationary crash in 2007 too, because once you run out of your savings or the money in your bank account, it eventually leads to delinquency rates in your mortgages and other loans. And it eventually leads to a deflationary crash, whereas we don't have that right now.
We don't have that.
So what I'm trying to say is you've got unprecedented amount of cash. People are going to build up more positions as they exit the bond market and as they exit the general equities markets. Absent a deflationary crash from deleveraging of all the loans, which I don't think will happen because we've seen the high cash savings rate in their bank accounts.
In
The
addition
money
to the
has to,
fact that the United States government is so heavily indebted that they really can't raise the rates too far, or else such a large percentage of their tax receipts will simply go to service the interest on the bonds.
yes, yes. And that's a 2020 catch 2020 situation, because it's, yeah, they probably can't see it go up a lot higher, which means what's going to happen, they're way behind the curve now, the inflation curve. What's going to happen is they probably can't afford to raise the rates because of such large public debt. So household debt, private debt is not such a big problem right now. So if you compare it to 2007, 2008, household debt's a lot lower right now in as a percentage of disposable income, or as a percentage of GDP now than
For the
back in
US.
2007. Yes, in the US, in most countries, I would say. And but public debt, on the other hand, as you said, is a lot higher than it was back in 2007 and 2008. So the government's kind of stuck where they need to raise rates to try and taper down inflation, but they realistically can't because the public debt is so big. So we'll see what happens, but it's going to be an interesting scenario.
It is very interesting, and it's very important that you mentioned the 1970s, where we had this this economic condition known as stagflation, where the economy is not growing and yet inflation is going through the roof. What's even more interesting is if we see the parallels from your charts there, the difference between the 70s and today is that the US did not have these budget deficits that they have today. And so Paul Volcker, who was chairman of the Fed, credited for raising the interest rates above the rate of inflation. He could afford to do that in that environment. But today, if they were to do that, essentially they break the sovereign debt market of the US. And that is, of course, the sovereign debt market for the reserve currency of the world. So if we take a look at the 70s and we see what did well during stagflation, it's basically all energy. And so you mentioned oil there. What's a great lead into our next section that I know viewers want me to ask you is, which sector do you believe is going to be the primary beneficiary of all this money flow? So where is all this money going to flow into, and why?
So yeah, the money's going to flow. So as I said, people have unprecedented amount of cash already. They're going to have more cash from as a result of selling down on their bonds and general equities. That money has a very narrow path to go through, which is basically the energy sector or the commodity sector. Right now, we haven't seen such big supply deficit everywhere across the commodity sector, right? So we've got deficits. Basically, we've got supply constraints on aluminium, copper, cobalt, silver, gold, everything, oil, gas, uranium,
Anything that can't be printed.
Exactly. So I think the money will have to eventually go through that very narrow door into commodities, and it's just going to blow out the market, because as you know, the US Treasuries market, so the bond market, sorry, just in general, and general equities are the biggest markets out there. If the inflation rate is also going up really high, so the interest rates have got shooting up like this, that also means those assets that are typically considered hard assets that are very exposed to, I guess, the leveraging effect, like your houses, like your real estate, because they are very largely dependent on how much people can borrow. They are likely to attract, in relative terms, less capital in those sectors too. So I'm thinking all the money out there will eventually have to divert into commodities, which is why I'm hugely bullish commodities. Right now, I think there's the biggest energy problem. So I think energy sector will take off first. And historically, it's also shown that energy takes off first. So if I just go share my screen again.
And so we're saying, okay, we're rotating out of credit markets or debt markets into tangible assets or commodities. And what is it about energy in particular that makes it rise first? Is it due to its inelastic demand, so that, okay, one day we can go without using tech subscriptions and things like that, but if we don't have, we've seen, especially with the Russia-Ukraine situation, if we don't have energy is life, and cutting off that supply, we've seen that the TTF Dutch natural gas futures take off like a meme stock. What is it about energy in particular that makes it outperform to such a degree during a stagflationary environment?
So right now, as you know, back in the 1970s, for example, we hit peak oil in the United States, which drove energy prices up. And that drives inflation even higher, if you think about it, right? Because energy, as you said, is life. Energy is fundamental to everything that we produce. Energy is what drives GDP of an economy. So basically, if you don't have energy, your GDP is going to go way down. But what happens when an energy crisis environment is governments, like we're doing right now, try to get their way out of it by stimulating either fiscally or through their monetary policies. And
Which
what
of
that
course
means is
stokes
it's gonna,
demand.
yeah, it boosts
Yeah.
demand for energy, while it should be tempering down the demand. And really, this is what we've seen in the 1970s. So if you look at the beginning of the commodity cycle back in the 1970s, which really started in 1970, or very beginning of 1970, or late 1969, late 1960s, what you've seen is this is use oil, so oil divided by gold. So this is oil's performance relative to gold. And what we've seen during the last cycle was it outperformed gold first, and gold came down and outperformed oil. And oil always runs first in, well, from history, oil always runs first. So if you look at the 2000s commodities boom as well, this is 1999, oil outperforms gold massively, and then gold outperforms oil during the late stages of the commodities boom.
So is it accurate to say that as oil takes off due to some kind of imbalance in supply demand, there's a lag because it takes some time for the average person to see inflation really hurting their hip pocket, and then it starts to become a topical issue. And then people search for traditional safe havens from such inflation, which is commonly thought to be gold.
Yes, that's exactly how I would look at it. So from my experience, things have to be imminent for it to absolutely take off. So we've got an energy crisis. So in Europe, for example, things are getting very imminent, right? So we've got like Mercedes-Benz, potentially not utilizing natural gas anymore and trying to swap over to oil, for example.
Mm-hmm.
We've got like Germany, for example, in like massive,
Back to the
blackout
Stone
and things
Age.
like,
Yeah.
Yep, looking for firewoods and things like that.
Oh, man.
So these problems are imminent, which is why I think natural gas specifically in European countries have absolutely taken off. Oil also is imminent. It was very imminent until, obviously they've started releasing strategic petroleum reserve of 1 million barrels per day. And I think it will become imminent as they stop the SPR release.
Absolutely. There's a finite reserve, and that's scheduled to end next month in line with the US midterm elections. I think leading into that next section of yours and I am super bullish on uranium. What we have now versus in the 70s people, it wasn't so badly, or it wasn't so frowned on to drill for oil to increase that production. Saudi Arabia came to the world's rescue, and they increased somewhere from around 5 million barrels a day to somewhere around 11.2. They're already thereabouts. The Saudis have said they can increase maybe another 1 million barrel a day in terms of their output, not coming online in 2027. So with the world reaching close to that spare production capacity for oil, and with this negative thought process around fossil fuels, this leads us into the uranium thesis to say, well, we as a species need a source of energy that has an appropriate energy return on energy investment that is also carbon-free emissions. And I don't know about you, I can only think of one thing that fits that description. Uranium. So we thought oil did well in the stagflation last cycle, and I believe it will be the case in this next cycle. It's actually my largest position. What is it about uranium that really gets you super bullish?
I think it's just the return that it's shown to give in the past cycles. So if you look at uranium, I'll just share my screen again.
Absolutely. And it's currently one of the few commodities still trading under its cost of production, which is crazy to think about when you've got this perfect setup, and yet uranium is still trading at less than the all-in sustaining cost for most producers. It's almost like a perfect storm.
It is. So if you look at uranium, for example, obviously Paladin Energy was the biggest performer last cycle. It did 134,274% from the low to the high. Like, I mean, which sector gives you that type of return, right? And this is not the only example. And you can see like Bannerman Energy, for example, where it did, I must have deleted it, 50x within like 300 days or something like that, 390 days or something like that.
Just over a year, 50x
yes,
return on investment.
Yes. And you've got Energy Fuels, for example, which did 5,677% within 302 days. So this is a very small sector where if any kind of money came into the sector, any decent amount of money came into the sector, it can absolutely just blow out and just go vertical. And that's kind of what I'm expecting to see over the next few years. And so I'm in it for the return. And obviously, I feel like I'm investing in the right sector for a good cause. Well, obviously, by doing this, I'm promoting the nuclear energy sector, which produces the cleanest, the safest, the most efficient form of energy to humankind.
Absolutely, which is what we
and
need.
as you said, energy is life.
Absolutely, energy is life. So you're giving life to the world, Scotty. I love it. As a uranium investor.
Yes, hopefully.
Do you know, just off the top of your head, I'm putting Scott on the spot here, guys, so don't hold him to the fire, what the market cap of the entire uranium sector would be? Ballpark figure?
Right now?
Yeah.
I think it's around 40 billion right now.
40 billion, that's all.
Yeah.
So as Doug Casey would say with regards to the silver market, when you have this capital that gets the green light for institutions, for example, to move trillions potentially of wealth into such a small market, it's kind of like siphoning Hoover Dam through a garden hose. And I think that's it's such a crazy thing to think about. When you look at those charts that you showed, how vertical they went, like it's one thing for something to increase steadily over time, but when you think of, just over a year for 50x gains, it truly is insane. And I think that speaks to how small the entire market cap of the sector is. All these things seem to be ticking the boxes for me, Scott. We've got a decade that the demand is certainly going to be there. The supply has been almost exhausted, especially with the invention of SPUT, the Sprott Physical Uranium Trust, sequestering that uranium on the market. And we've got such a tiny market cap for the sector. It just won't be, as a vessel, if you like, it just won't be able to take all that capital coming in. And the relief from which will have to be a rising tide to send the rockets to the moon.
Yes, that's right. And there is one fundamental difference that I always highlight, and it is really the inventory levels and also the demand supply picture. So back in the 1970s, we had a huge boom in the uranium price as well. But the big difference here is that this is uranium production in the shaded blue area. This is uranium demand in this navy line here. What we did have back in the 1970s was a massive supply surplus. So surplus of supply.
Wow.
As opposed to supply deficit.
Which is really counterintuitive. Just to explain that for the listeners. So normally people understand, okay, if there's no supply of something like we've seen with oil and natural gas, and the demand stays level, the price skyrockets as a relief. But you're saying, even though we saw such tremendous gains in that particular cycle, that was in a market that had inventory.
Exactly. Which is crazy, which is mind-blowing, right? So even the uranium production was still way higher than uranium demand right now. So let's go to the 2007. So you've had all this surplus. So anything that's sitting on top of this navy blue line, right, is uranium that's been built up during that period. Yes. So you've had all this inventory that was built up in 2007. Let's say 2007, we didn't really have any inventory issues per se, because we've had so much inventory from all this period, all this building up. But even then, we had stocks, as you've seen, that did over 100,000% returns, or 50x return within a period of 1 year. Now, this is really interesting because now we've had all this supply surplus, and so supply deficit for a period. We've drawn down on those inventory. At the same time, we've got nuclear renaissance. At the same time, we've got financial players joining, like SPUT, so Sprott Physical Uranium Trust. We've got Kapat, Kazatomprom is starting the ANU. So just to give you an idea of this supply and demand picture, and why I don't think you can compare this run to the previous cycles, and why I think it will go far higher this time around, is really the inventory. So we've heard from Spot, for example, that they are finding it hard, finding it more difficult to try and source above ground uranium, right? So we've also got Japan going to Kazakhstan. We've also got China going to Kazakhstan to talk about uranium supply. So we must be going through a time where it is hard to find above ground inventory. So inventory is almost done, right?
Precisely at the time where I believe most of the long-term contracts are due to roll over or to be renegotiated in over the next 18 months. And you've got guys like John Borshoff, the CEO, who was the CEO of Paladin and basically took that executive team over to Deep Yellow. And those guys are sitting on huge deposits in Namibia. And he's saying, I just read, I believe, an article from him beforehand saying that we're not interested in negotiating with utilities until they're serious. In other words, they need to give us an incentive price to go through all the hellish processes to get these mines into production. They can't afford to do that for $60 or even $70 uranium, right? What do you think is going to be the incentive price for these guys to get back into production? And how high do you think the spot price could potentially go in the event of a squeeze?
So I don't really think of it that way. So I don't really think about it in terms of the contracting and how much they're going to contract it out for. What I think is going to be more important in this environment, due to low levels of inventory and due to a demand and supply picture that we've never seen before. Let me just touch on maybe the demand supply picture, right? So
absolutely,
last year, 2021. So we've got no inventory left. Let's just have that in our minds, right? So, I mean, obviously there might be inventories that, Japan's built up and things like that. But my question would be, why are they going to Kazakhstan and talking to Kazakhstan if they have a lot of inventory lying around? So that's
especially given now that they've committed to restarting most of their fleet, which means that inventory is not going to come on and be available to sell on the market. They're going to sequester that for themselves, and they need more inventory to operate that fleet, right?
Yes, I think so. So now let's just go to the demand supply picture, because the biggest things with the demand and supply is that we already had an existing supply deficit in 2021. So I think the numbers are something like 200 million pounds of uranium that is demanded per year. And we had a supply of 135 million pounds. So we already had a shortage of 65 million pounds per year. And that's prior to Spot coming in. So Spot also last year, I think, sequestered 40 million pounds of uranium over the last 12 months anyway, since they came online. We've got Kapat. By end of this year, they will raise $500 million to buy more pounds. And if you have it at current price, that's like 10 million pounds of uranium by Q4 this year and Q1 next year. And you've got all these other factors that are just so throwing this out. You've got nuclear overfeeding and underfeeding, which is a 30 to 50 million swing. So add on to that, all those supply deficits, we could potentially have the entire supply uranium, 100% of supply uranium, which now becomes the supply deficit figure.
Wow. So in other words, is what was available for supply swings to the demand? Is that what you're saying?
So no. So what was, no, you could say that, but we had so just to recap, so we had something like 35 million of production supply, 200 million demand in prior year. Now add to that, the gap grows by another over 100 million pounds.
I see. Okay, so that deficit goes from, let's say, 65 to maybe 165 in that ballpark figure?
Yes, I would say so. It's a very rough figure, but I think the supply deficit is now so great that we don't even need to get it exact. Like, I mean, it's immaterial whether it's like 100 million pounds in supply.
The point is, it can't continue.
Or 200 million pounds. Yes, it can't continue. It has to end. And I think what will drive, and going back to your previous point there, I don't think it's going to be the contracting which determines the spot price or the price of uranium, that people will ultimately have to pay either through contracting or on spot price. And the reason why I say that is, what is the value of last bottle of water out in the desert when you've got 100 people lining up to get that one bottle of water? It's like, it's infinite, right? It's like, how much is a person willing to pay for that last bottle of water? And that's kind of what I feel like for uranium is that, I mean, people are always talking, you know, $100 per pound uranium, $200 per pound uranium. But I'm like, we've never been in this situation where even if they wanted to pay high prices for it, we might not even have any uranium left, let alone have like all these people playing it. So it's basic human psychology that if things become tight and if things become pricey, you want it even more. And I think that's exactly what's going to happen.
Especially when we're talking about a matter of national security, right? Like energy security is such a topical thing. And I guess
100%.
That's cleared things up for me quite a lot, because I've heard you mention some crazy figures when it comes to potential, you know, hypothetical spot price for uranium. But it makes sense now that you've shown the viewers the difference between the last bull markets where we had inventory versus today we don't. And yes, okay, I understand most of the sales from the producers to the utilities occurs on the term contracts. But with regards to the spot price, as you said, if you rock up to the exchange and there's nothing there, I mean, it's unobtainium and unobtainium, right? Like,
that's right.
That's what
and
sends
even,
that.
Even with the contract prices as well. Like, what is? I mean, if you're the last uranium producer, if you've got one uranium producer that hasn't contracted yet, and there's available supply of uranium, and you've got 100 utilities lining up to sign up with that producer, what is that uranium worth?
Yeah, wow.
Like I don't know. So I think it's the way people I think look at it. It's completely different. And I think one of the most bullish factors is going back to the macro picture, which is unlike what we've seen in 2007. So obviously we had uranium prices peak at $140 per pound back in 2007. And we didn't have, if you think about it, we didn't have all the liquidity coming flooding out of the general equities market or the bond market at the pace we're seeing it right now. Like the interest rates weren't rising nearly as fast as in 2000. Didn't rise as fast as we are seeing it rise right now. So the flood of money that's coming out of the bond market, the pace of money coming out of the general equities market, on top of also the unprecedented level of cash that the households have to invest freely in this commodity sector, tie that all in together.
With the ability to do that now with these physical vehicles like Yellowcake, Sput, and Kapat.
Yeah, exactly.
Wow.
I think $100 per pound uranium, $200 per pound uranium, I think is mega. Like, I mean, I think I would go as far as to say that's almost bearish.
Wow. Okay. All right. You've convinced me. You've convinced me to raise my target price for the spot price. That makes an awful lot of sense. I've got 2 viewer questions for you, and then we're going to move into our ROI segment. The first viewer question is a particular stock, and remember, this is not advice, guys. Okay, so this is just our thoughts if we have them. And he's asking about GoVX as a uranium play. Do you have any thoughts around GoVX in particular?
I don't, and I'll tell you why. When I invest in the uranium sector, and I know that the mining process, getting the permitting, getting the licensing can be quite difficult, for example, in certain jurisdictions. So what I like doing is just picking up the key jurisdictions across the world, and that's Namibia, that's Wyoming in the USA, that's Athabasca Basin in Canada. And I like just sticking with them, and I don't really explore. I've got small positions here and there, like in Niger and Botswana and things like that, but they're a very small place for me. And my main focus is in Namibia, which is, I think, the second largest producer in the world of uranium after Kazakhstan. Kazakhstan obviously is Kazatomprom, but I don't own Kazatomprom. Namibia and Athabasca are my top 3 jurisdictions, and so I stick with them. I think I like to be sure that I'll be getting the return, and I favor. So if it's a difference between let's say I can invest in some uncertain jurisdiction and get 20x my money. Let's just say, and I can invest in a jurisdiction I'm much more familiar with. I know that they've got established producers in place. They've got state-owned corporations, and things like that. And it's a lot, it's a lot less risky from a jurisdiction or geopolitical risk point of view. Then, and it's only going to yield me, let's say, half the returns. Let's say instead of getting 20x, I get 10x. But I am more sure about
actually
getting
get the 10x.
Yeah, I would rather invest in the sure 10x, surer 10x than a riskier 20x, if that makes sense.
So, and that it gives you that sleep at night factor. Well, that makes perfect sense. It's time to move on to its ROI time. So in this segment, we're going to focus specifically on the ROI theme. And to date, Mr. Scott, what is your highest return on investment that you've made?
So that probably takes me to the commodities boom last cycle. There were a couple of silver miners and quite a lot of silver miners that did over 10x. But mind you, I think I've talked about this many times, is that I actually wrote a lot of the silver gains down. But what if I had to pick one where we took the profit? I say we because I was only a university student back then, and most of my funds were invested through my dad.
Thanks,
we did invest in, I think it was a company called Silverstones, and it was a silver royalty company. When I bought it, it was after a crash, or maybe almost towards the end of the crash, the great financial crisis. And I looked at the royal streaming company, and it essentially, I forget the exact figures, right? I might be completely off in terms of the figures, but I looked at this one particular silver royalty company, and it had more cash than its entire market capitalization. So I think something like its market capitalization was something like 50 mil. It had a cash position of about 100 mil from memory. Like I could be off here.
Rough numbers.
And I can't even get access to their records because I think they've been taken over by Silver Wheaton Precious Metals, and they were earning like some crazy cash flow compared to their market cap then. So I said to my dad, like, this is like almost as good as a sure bet.
That's as good as you're gonna get. Like royalty too. Like you don't even have to worry about the margin squeeze.
They had no debt. And I was like, this is the one. So after we bought it, soon after my dad bought it, I think it got taken out by Wheaton Precious Metals, and it was like an immediate 3x within a period of maybe a few months. And then Wheaton Precious Metals. So basically, shares got converted to Wheaton Precious Metals shares. And it did another like 7 to 8x on top of that. So I think it was like 20 to 25x gain from when we bought it to the top. And I think my dad ended up selling it at 15x, which is pretty good.
That's pretty
good. And he had a decent amount of money in it because I thought it was a sure bet. I said, just buy more of this than everything else out there.
Did he give you a raise in allowance? Did you become the favorite son after that? Surely.
Not really. No, we had a lot of fun during the silver market from 2009 to 2011. I was with them at the time, so I went over to I was like on a vacation from university. I was in Korea with them, and like we were waking up every morning just laughing our heads off, like because it was just so hilarious. The amount of gains like we were seeing every single day across all the silver stocks that he owned was just hilarious. And if you look at some of the silver stocks, then I can show you some of the charts. It's actually quite crazy what a commodity boom can do to you.
And especially circling back to the point we made before about when you have such a small market cap for a sector, when that capital goes in, and silver is similar to uranium in that sense, it's a tiny market. When those capital flows come in, the price just gets bid up.
Oh yes, 100%. So we had this Wheaton Precious Metals, for example. This is one of your biggest silver plays, and it's not even a speculative play, and it did 18x your money within 878 days. So commodities for me, and I'll tell you one of the biggest mistakes that I've made as well while we were at it. And this is why I just refuse to trade in and out. Okay, so I think this is it. So this is RRL. I bought it with my personal money, and it was only a couple of grand because I didn't have a lot of money back then. I bought it at 11 cents. I was just going through my records before. I bought it at 11 cents. I think I might have bought it here. And I probably saw it go down a little bit, like maybe almost half in price. And I was relieved when it came back up, sold it at like 15. And look at what it did.
Oh my goodness.
So I made a mistake because that's when I think when you're a new investor, and I was relatively new. I started in 2004. I was relatively new, and the emotions get you. And this is why I just refuse to get emotional with investments anymore. And I just stick to my plan. This is just like with uranium, for example, like I have a clear plan of when I'm going to exit, when I'm going to sell out, and I'm just going to stick with it. I don't care about the small niggly movements like we've seen yesterday. It's just like, I'm going to stick with the trade and ride the entire bull, because I missed out literally from, let's say, 11 bucks or something like that. I missed out on a 60 bagger. So if I held on to this, I had a pretty good decent chunk. It was like, yeah, I don't exactly remember how much I had, but I calculated the potential gain out of it, and across not just this one, I had many that did something like this, 20x, 30x, if I hadn't sold out. And yeah, it hurts, but yeah, I could have been a millionaire by my early 20s or something.
It's okay. There's time for the new bull market, and you still look like you're in your 20s, mate. So you're doing very, very well. In terms of your top 3 picks for the next decade, they don't have to be in uranium necessarily, but maybe if we talk about a producer versus a developer versus an explorer, do you have any thoughts on those?
I do have thoughts. So yeah, I can tell you, my biggest producer, and this is not financial advice, this could be horrible, but my biggest producer position is Paladin Energy. So it's something that I bought quite early in the cycle, and I'm continuing to hold, and I plan to hold for quite a while. My biggest developer position is Bannerman, and they're all in the Namibia region, as you can see. Like, I mean, Namibia is an established mine. They've got Rosting Mine, which is also run by the Chinese. They've got the Husab mine run by CGN Mining, which is also the Chinese firm. They've got a Riva uranium, I think it's called Okapi deposit, which is owned by a French state-owned company. So I feel like it's a safe jurisdiction. They're open, they're geopolitically neutral. They're open to foreigners coming in, buying out, and things like that. So I've got Paladin Energy. I've got Bannerman as my biggest developer position. And in terms of the Explorer, I mean, I think my favorite has to be 92 Energy. So that is
I've seen you post quite a lot on Twitter about 92 Energy. Is it just the shorts, or is it more than just the short positions? Tell us more.
So 92 Energy, I think, has probably made the best discovery, uranium discovery this cycle. So, and if you just compare it to the peers, okay, let's first talk about maybe how high the explorers can go in terms of valuations. So
let's do it.
Back in the 2007, we saw Deep Yellow, which was an explorer with no resource estimates or reserves, go to a peak market cap of 650 million Aussie. That's almost, I mean, US dollar and Australian dollar was trading at parity then. So it's effectively 650 million US. Right now, I think 92 Energy, I think it's trading around 50 million market cap right now. But what I think will happen, at least, and we've talked about the macro picture, what I think will happen is you need to ×3 everything from the 2000s just to get back to the valuation 2000s. And the reason why I say that is you've just got a whole lot more money. And let's ignore the liquidity provided by, the checkable deposits, because I think that's another huge factor. But let's just look at M2 money supply. And you go to 2007, what you see here is money supply was sitting around the $70 trillion region, something like that. And then right now it's sitting at 21. So M2 money supply has tripled since 2007 peak run. So that just means
just for that moving forwards.
I think so. Because you've got that much more money now potentially chasing commodity sector as well. So if I just go M2 money supply, this is just to repeat the last cycle, I think the valuations of these companies will have to at least triple that. On top of that, we've talked about the inventory, we've talked about demand supply, we've talked about everything else. I think it could go far higher than the last cycle. So deep yellow, as I said, 650 million last cycle in Namibia. I think they had properties in Australia too, but they were valued at 650 million. 92 Energy, I think they've hit the best grade uranium. They hit the deepest. Like, I mean, depth really matters when you talk about uranium mines as well, because that, I mean, if you think about it, like, let's say take for example, I'm not knocking any companies here, but PurePoint has released quite good grades. I think they released quite good CPS counts, for example, over 0.5 meters, right, depth. So basically, that's like coming up to my knees or something, right?
Yeah, you could dig it with a shovel.
That's well. I'm talking about the actual mineralization.
Oh,
the strike length of the mineralization, basically. But 92 Energy, on the other hand, they've struck it over 40 meters, which means instead of mineralization coming up to my knees, now it's like basketball court and more. You know, like I'll need to look high up in the sky to see like the total, you know, depth of, you know, the uranium mineralization found in 92 Energy. So, and you know, they've got pits open across, I mean, they're all open in all directions, which means they still have a lot of room to grow where they are striking mineralization. So at the Athabasca also attracts premium typically. If you look at the previous valuations, like Heather Explorations, Rough Rider deposit, for example, I think they attracted quite handsome, I think, over $10 per pound for uranium in the ground during the bear market. So I think they were acquired in 2011-12 when uranium prices were sitting around $50 to $60 per pound. They attracted over $10 per pound in the ground. In the Athabasca Basin, which means they probably, I think it was Rio Tinto that acquired them. I think they paid like 20% of spot price, almost there, like between 15 and 20% of spot price, which is quite high. So if you imagine that they find something similar, let's say, this is a pure guessing game. Let's say 50 million pounds of uranium. And let's say uranium price goes to even $200 per pound, and they attract 20% of the uranium's price as the price paid for in the ground pounds. Then that's a lot of money. I don't want to spit out a number here, but that's a lot of money. So I think 92 Energy is probably my favorite explorer. There's another one that's really caught my eyes, and they've got a very diversified portfolio, which I think I like just as much as 92 Energy now, is Okapi Resources. So it's OKR on the ASX.
Okay. Tell us a little bit about that. I'm not familiar with the company. Okay,
I'll tell you a little bit about this OKR. And the reason why I picked it up recently, quite recently actually, is the pattern that I saw on this chart. So this is Okapi. And I don't know if you've seen me talk about the leading pattern at all, but
I think everyone that's interested in uranium seen it. Scotty, talk us through this famous leading.
So this is the leading pattern. So flatten out, you have the initial spike up, and then you come down like this, right? To around this level. Now, I've had a couple of names this cycle that played out really well. I didn't really know that it was the leading pattern. I just thought the charts looked good and bought in. But there are two names that I got in, which gave me the quickest and the fastest return, and it's this pattern here. So this is NXM, and what you see here is exactly the same type of pattern here. Oops, let me just zoom out to daily chart. Zoom into daily chart. So what you see here is exactly the same pattern as Okapi, which is go up, you go sideways, rocket higher, and then slow grind down, test this level, and then shoots back up.
That just reads like a broken chart. The sheer verticality of some of those moves it gives a whole new meaning to a rip your face off market, doesn't it? I mean, that's
right. But look at how similar the patterns look on this one, right? And another one that I had was RDT. And once again, I didn't really know the leading pattern back then, but tell me if you can see it here.
We move
It's
in.
the same pattern. So
Sideways
initial run up,
consolidation for a little.
sideways,
We come
boom,
up, down, sideways consolidation, and then
go down to this level, and then boom.
Moonshot.
Yeah.
Wow.
So I see the same pattern for Capi. And so I really like the pattern. So I started looking into the company. And I mean, I had on my watch list ages ago, but for me, the price just wasn't good enough for me to get in. But I got in at 23, which isn't great. I wanted to get it around the teens, but my money didn't come through quick enough from selling some of my PM. So I had to chase it at 23. But yeah, with this company, they've got 50 million pounds in resources and reserves in the USA, because I think the USA just generally will be a pretty good jurisdiction for uranium going forward, just because of energy security. Absolutely. And you've got all the money that's coming into nuclear power in the US. So they've got that in Tallahassee, Colorado, Tallahassee, in the USA, 50 million pounds. That's the base. These guys are only trading it right now, I think something high 30 million. Let me just check.
And are you with these
36?
Are you seeing these as potential buyout opportunities, or are you expecting them to hit production?
With these companies, I don't really have any thoughts around whether there will be buyouts or not. I don't think it really matters, because I think it's all going to be about money flow going forward. So that's kind of what I'm looking for. So I'm buying. So you're using
that valuation formula of, okay, yes, it's uranium, but it's in the ground, and so we need to discount that. It's not as if it's, you know, been dug out of the ground and sitting on the spot market. How much uranium have they got? What sort of discount do we give it? And then that might give you a valuation for the whole company. Is that the way that you're thinking about these particular plays? Yeah.
So with Okapi, it's trading at 36 million market cap. Just looking at it today, which is cheap. It's got 50 million pounds in the ground. It's got 6 Athabasca Basin projects on top of that. So and they've done some rock chip sampling. I mean, rock chip samplings are not that reliable, but they did have some good rock chip sampling across the Athabasca Basin projects. They have, I think, 2 more little projects in the United States. So you're getting, and they've got a gold project in Australia. So I feel like
that's a lot going on for a $30 million market cap.
If you look at a lot of the Athabasca plays right now that haven't struck anything, they could be trading anywhere between 20 to 30 million market cap anyway, without the US, without 50 million pounds of, you know, resource estimates and reserves in the United States, without the 2 additional US projects, without the gold project. So I feel like I'm getting all those projects for free when I buy this share. When you compare it, when you benchmark it, does it mean that it can't go down? Of course, it doesn't mean that. But yeah, I mean, Okapi is probably one of my other favorites right now when looking at a smaller explorer. These are risky though. Like just as with any explorer, people watching this have to understand that they are very risky plays, and they are like my lottery tickets, if you want to call it that. So I've got bigger holdings in the producers and the developers. These are my lottery tickets. So please be careful when you invest in these things.
That's right. Do your own due diligence, guys. You're responsible for the decisions that you make, and position sizing is just as important sometimes as asset selection. Yes. So make sure that you don't do anything silly, and continue to do your own due diligence. Well, Scott, thank you so much for your time. I really, really love it. I'm going to go and digest all the wonderful information that I've just learned. I'd love to get you back on in a couple of months to maybe red team the thesis and talk about, you mentioned you have a plan and you're sticking to that plan until you hit your exit points. I'd like to ask you about what sort of triggers or signals that you see might give you the inclination that it's time to sell or start to exit the sector. So I'd love to be able to talk about that at a later date. In the meantime, did you want to leave our viewers with anything, any particular message?
Yes. John 3:16. I think this is really the essence of the Bible, of the good news. And it is, for God so loved the world that he gave his only begotten son, that whoever believes in him will not perish, but have eternal life, everlasting life. So this is really the good news, that if you believe in Jesus, you'll be saved and you'll go to eternal life. You'll have eternal life.
Excellent. I love it. Live the good life and the rewards shall follow. Thank you very much, Scott. Greatly appreciate having you on the show. We look forward to having you back for a future episode. In the meantime, thanks very much, guys. Sownreap Capital, I'll have the details in the video link. Make sure you like and subscribe to Scott's Twitter and Sownreap Capital with him and his partner, Steve, so that you can continue to hear the good news. And we wish you all the best, guys. Stay safe, and we'll be back with another episode of the ROI channel in future.